over to you.
Thank you very much. Right, does this work? Yes, perfect. Good afternoon. The received wisdom is that small things are nimbler, faster, and better run. Whether it is rodents surviving a meteorite strike or fantastic Mr. Fox, the old story where the nimble prey eludes the lumbering predator and prevails through sheer wit and ingenuity is seductive. In business, of course, we love a corporate underdog, sticking it to the incumbent. The underdog starts up, disrupts, grows big, itself is attacked. There is competition, consolidation, acquisition, market share grab. And if a company goes under, its corporate carcass is there to be picked over by its rivals for the juiciest bits, with the rest discarded and recycled. Does all this apply to the banking industry? Is small beautiful? Do small challengers grow to threaten the large incumbents? Does the industry change, morph, and advance as technology and customer demands drive it forward? Does it find new ways to be profitable, useful, and additive? In short, is banking a normally functioning sector? We'll touch on the following questions. Is banking a normal sector? Is bigger better than smaller? Are banks investable? Should they be investable? Challenger banks and their challenge, and a conclusion. So one characteristic of a dynamic industry is consolidation. You only have to look at the decline in the number of banking institutions in the US over the last 3 decades to see that there has been substantial consolidation over there. Over 14,000 institutions, declining to around 5,000 in 30 years. The UK is no different, where the 5 largest banks along the bottom are a combination of the 16 original banks along the top, and the litany of names and initials that have been and gone is testament to the continual forming and reforming that has shaped the industry we see today. It is nevertheless true that in the UK more recently there has been a surge of competition from the so-called challenger banks, and we'll talk about their impact later. The trend, however, over time has been for bigger and bigger banks as consolidators hoovered their way through the industry. The reasons and benefits are seemingly obvious: economies of scale, bigger balance sheets, funding power, broader reach, longer client lists, more products, and the greatest goal of all, the cross-selling of those products into those client lists. Cross-selling is viewed by many banks and investment banks as the holy grail. If you can have one client buy 8 products, when they originally only intended to buy 1, then you have justified all those acquisitions and integrations. 1 counterparty risk to manage, 8 revenue streams to enjoy. Wells Fargo have shown us how not to cross-sell, but undoubtedly it is one of the key reasons these mergers happen. Big banks have other benefits as well. They have purchasing power, helping to reduce the price of debt for their corporate customers. They are more diversified, both geographically and sectorally, helping to reduce concentration risk. Let's have a quick look at the US market, where they are also apparently more profitable and efficient. According to the FDIC Quarterly Banking Profile, Q2 2017, there are in the US 752 institutions with over $1 billion in assets, and over 5,000 institutions with assets under $1 billion. The larger institutions have a higher return on assets, higher return on equity, and lower non-interest expense to assets than the smaller ones. The FDIC also has data for the last 6 years for these same metrics. If we compare, we can see that in 2012, there were 660 institutions with over $1 billion in assets versus 752 now, and 6,500 institutions under $1 billion versus 5,000 now. So that's a clear trend towards big banks. What is also interesting is that if we look at return on assets between 2012 and now, we can see that the improvement is hugely skewed towards the smallest and the largest banks. Banks with under $1 billion in assets improved by 25 bips. Those with assets between $1 billion and $10 billion stayed more or less static, and the very large institutions improved by 13 bips. This throws up some interesting potential conclusions about the US. That the consolidation is working, that the measures taken after the crisis hit the smaller banks the hardest, and therefore they've had the most to improve. The very largest institutions in the US have done a very good job of improving returns despite their size and the regulatory environment, or maybe the US dealt with the crisis better than the rest of the world. That explanation, however, is a conversation for another day. It is true that the US banking sector is a very different sector to the UK one, and the parallels are difficult to draw. But the question remains, are big banks more efficient, more diverse, better value for shareholders, and better for consumers? At KPMG, my job is to advise clients who are looking to sell public equity, be it primary or secondary, to institutional investors, so IPOs and capital increases. It might be helpful to look at the UK banking industry from the point of view of the institutional investor, from the point of view of investability. So how does an investor value a public equity investment? It's almost all about returns. Return on capital employed, return on assets, total return, which is share price increase plus dividends. So when an investor looks at the UK banking industry, what do they see? Well, first they see a very stratified industry. 5 big global banks, a slew of larger challengers, and finally a raft of smaller challengers. And then there are the retail banks, Asda Money, M&S, Tesco Bank, and Sainsbury's banks. These banks all tend to focus on slightly different things. The larger banks tend to be providers of everything. The smaller banks tend to focus on particular niche areas. Investment theory tells us that there are a number of standard trade-offs in value creation. Return versus risk, return versus growth, short-term versus long-term, margin versus velocity versus leverage. All these can be applied to the banking industry. What sort of risk is acceptable to achieve a certain return? How much return should I sacrifice to invest for growth? What short-term decisions do I need to take that might sacrifice long-term growth? And how do I manage profit generation versus business cycle versus return on equity? They are very difficult choices, but company CEOs have to pull on these different levers in the right measure, in the right direction, at the right time to deliver value and growth now and for the future, all for the benefit of the company and the owners of the companies, the shareholders. So let's look at how investors approach valuation generally, forgetting for a second the challenges of time and business cycle, and focus on profit generation, assets, and leverage. The DuPont identity or chain is a useful tool. Return on equity, here it is. Return on equity breaks down into return on assets, and return on assets multiplied by leverage, with return on assets in turn broken down into return on sales and productivity. If you are a CEO and you want to attract investors, you want to maximize the output, the return on equity. So how do you do it? There are 4 separate elements: net income, sales, assets, and equity. You can boost sales, but if you do that, you need to make sure you boost net income, i.e. maintain your margins. Otherwise, your return on sales and your return on assets will fall. You can boost net income on its own by increasing margins or reducing costs, but will cutting costs have a detrimental effect on sales? You can reduce your assets to boost return on assets, but this could reduce your leverage. Or you can increase your assets to increase your leverage, boosting returns that way, as long as your net income grows as a result of your asset increase. So far, equity stays the same because investors are not a lever you can easily pull. This model doesn't quite translate perfectly for the banking industry because instead of sales, they have net income, so they start from the basis of return on assets, but we'll tackle that a bit later on. Nevertheless, for banks, obviously, it was the increase in leverage that made the sector so vulnerable in the run-up to the financial crisis, but you can see why they did it. It's a simple way of turbo-boosting returns. I use simple in its most complex way. So what happened after the crisis? Assets were sold and equity was raised. Selling assets had a detrimental effect on net income. There is also an added complication for investors and for banks. To guard against future crises, substantial quantities of capital had to be parked on the balance sheet. In this graph, Basel III defined Tier 1 equity rises from around 7% in 2012 to 14% this year. This capital came from capital released as assets were sold and from all the equity raised from investors. It sits on the balance sheet as a form of very expensive funding, guarding the door, as it were, but not going in. It's not able to be put to good use, generating income. It is also interesting to note that despite all the capital raised and the importance attached to those capital raisings, the Bank of England's Financial Stability Report in November 2016 pointed out that 3/4 of the capital rebuilding between 2009 and 2015 was actually achieved by reducing risk-weighted assets rather than increasing capital itself. It is notable that for all the publicity and pressure around raising capital, that actually it was changing the nature of the assets that had the greatest effect on capital stability. So return on assets is falling, therefore the return on equity numerator is falling, leverage is also decreasing, but remember we have also been through substantial equity raises. This has a direct effect on leverage as well, but it also reduces return on equity where the denominator is rising. So this whole unwind puts huge pressure on return on equity. Here, statutory return on equity is below 0, and underlying return on equity is just above 5%. Your return on equity is way below the cost of equity, not a sustainable state of affairs. How do you relieve this pressure on return on equity if you're a CEO? How do you encourage investors to think you're investable? You need to increase that return on equity. So if you need to increase return on equity and you can't increase leverage, you need to increase income. But that needs to happen without increasing assets too much. You need to find ways to generate net income without increasing assets. Hold that thought for a moment. The issue as to whether a bank is investable by institutional investors is critical to the very essence of the sector as a whole. Investability goes to the heart of whether small banks are safer than larger ones, how regulatory capital is determined, and where it is distributed. This is because ultimately, if a bank is deemed non-investable by investors, then it doesn't matter whether they're large or small or safe or not. They become a different proposition entirely. They become quasi-utilities. Even more than that, they have to become state-sponsored and therefore government-owned. They become one of those industries that are essential to society but not maintainable by society. They have to be provided by the state like defence or law and order. If they are non-investable, CEOs can no longer depend on being able to pull the equity lever. If they ask for more capital, they might not get it, at least from the market. If they can't get it from the market, then it needs to come from the government, or should I say, the taxpayer. There is also another reason why investability is important. Quoted banks have a very visible barometer of health, the share price, a sort of cardiac monitor screen that sits there beeping. Every now and then it crashes, the alarm goes off, everyone comes running, there is organised chaos, a large infusion of blood, equity, a stern warning from the heart doctor, the regulator, to get fitter, smoke, drink less, etc. History is full of these crises, Barings, twice, the secondary banking crisis in the UK, RBS, Lloyds, etc. Sometimes it's not one patient, it's the whole ward. The disease, as it were, can be highly contagious. So what are the share prices of banks telling us? Thank you. What are the share prices of banks telling us now? What does a health check reveal? Let's take that DuPont model and adapt it to banks. Let's focus on one other metric that investors use to value the banking sector specifically, and that is price to book. So let's introduce the price into the equation. Take the P/E ratio, which is price per share divided by earnings per share. If we multiply that by our return on equity metric, that gives us price to book. Price to book is price per share divided by assets minus liabilities, or if you extract intangible assets, tangible net asset value. So basically asking how the share price values the equity in the business. It's important to bear in mind that book value is a historical measure, can also be slightly a problematic measure, that valuing assets and liabilities can be difficult or arbitrary. Nevertheless, it is a very important measure of banks' health, or more precisely, how their health is perceived. At the moment, the UK banks, or at least the large banks, are at 1x book value, below 1x book value. That means the investment community believes the value of shareholders' equity is being overestimated, that the return on equity is lower than the cost of capital. Or to put it another way, either the banks think they're more profitable than they actually are, or investors are underestimating their strength. Someone is wrong. Investors seem pretty sure they are right. As you can see from the chart, the price to book ratio has been below 1 for a good many years. Book value is also important in the context of the market value of those assets that book value represents. The market value of those assets clearly fluctuates, the mark to market that Brandon mentioned earlier. This may not be a problem if the bank is able to sell those assets for book value above should it need to sell. However, if there is market dislocation, then potentially the bank may not recoup as much as it expects or enough to cover book value. This is especially true in times of stress. There is a circularity here because the most likely scenario in which a bank needs to sell its assets is an emergency measure and the so-called fire sale situation. This can either be when the bank is suffering a crisis specific to its own business, or more likely when there is some sort of systemic crisis. If it is specific to its own business, then it may be the prices it gets for its assets are not normal prices, as it may have to sell them quickly. Or in the systemic crisis, prices for assets are very unlikely to be normal, as buyers of those assets price in the unfolding crisis itself. This can also lead to a further cascade of sales, as other banks may be forced to sell their assets when they see the crystallized market values of similar assets other banks are being forced to sell. This fire sale problem is a key concern in a systemic crisis.
Do you think you might jump on to sort of about here?
Yeah. Okay. So, let me start there. So, KPMG published a study on challenger banks in the UK in 2016. The conclusions of that study are that challengers have a greater cost advantage, have a better return on equity, and have continued to grow in a shrinking market. If we look at cost-to-income ratios for 2015, the year the report covers, smaller challengers are at 58.8%, the larger ones 69.6%, and the big five are at 89.1%. We've updated those figures for 2016 as well, and you can see the gaps are starting to narrow as the groups converge. Return on equity also tells the same story. 3.8 for the big five, 8.6 for the larger challengers, and 20.5 for the smaller challengers. And again, updated to 2016. So are these challengers actually challenging? Are they taking business away from the big five, creating competition? Well, yes and no. The challengers have established themselves in niches, so buy-to-let mortgages or SME lending, for example. The very name challenger is problematic. Some of these banks maintain that they are not looking to challenge the big banks on a full service proposition, but on a product-by-product basis. This makes sense, as it is enormously difficult to convince an investor to move their bank account or the bank they use for day-to-day business. Also, as bank account management is a free service, banks can't compete on that product. Once you offer it for free, it's very difficult to start charging for normal banking products, but it takes away a key reason to move banks, a key potential competitive advantage. The danger for the big five is that if there are enough challengers competing on enough separate products, the big five will be left with the low or no margin products like standard banking, but with the high costs that come with being a high street bank. So, to a certain extent, the challengers, both financial and non-financial, are pushing the larger banks. And although the challenges in certain products, these products tend to be the ones that are easiest to challenge on, so those that consume less capital and give the highest return. Exactly the sort of products that big banks desperately need in order to improve their profitability. But going back to investability, how does the existence of challengers affect investability? There is no doubt that in the UK, the challenger banks are more profitable and generate better returns, but they have risks. Their niche products can be targeted by regulation or changes in market forces, and they have few or no products to fall back on. Buy-to-let is a good example of that. As an investor, you're geared to one product. Furthermore, their costs are low, but banks live off funding, and if they can't attract sufficient depositors, they're going to struggle to grow. Here you can see that attracting new customers is more expensive for challengers. Also, 80% of their total funding is provided by deposits, and retaining those depositors is more expensive as well, although it is becoming cheaper. Finally, part of investability is market liquidity and the reality that many of the challengers are quite small. So as an investor, you might hesitate before investing in some of the less liquid ones, especially in a crisis you need to sell quickly. The total market cap of the big five is 350 billion compared to the market cap of the challengers, which is 68 billion. If you take out the top two challengers, it's only 20 billion. So, like all investments, there is a risk-return profile that investors need to balance when looking at the sector. But all of them will have in the back of their minds that in the next crisis, where there will be one, this sector will once again probably be in the firing line. Therefore, the challenges of risk-return need to take into account dealing with a systemic crisis and which boat, if any, you want to be in when the wave hits. And systemic is the key word here. A crisis that affects a single bank, like Barings or the Co-op, is manageable. But they are the exception. It's much easier to imagine a larger crisis with systemic characteristics. Eradicating the systemic nature of the sector is probably impossible. You can try and create circuit breakers like huge amounts of capital, but how much is enough? Are contingent capital structures like CoCos real loss absorbers, real circuit breakers, or just paper tigers that will fold at the first sign of trouble? The banking sector is enormously interconnected, so the chances are the problem with one bank will almost inevitably ensnare other banks. Any significant banking crisis will be systemic, and any systemic banking crisis will affect the economy. It seems very hard to get away from that. Furthermore, the systemic nature is not just an interconnectivity issue where one bank drags down another, it's also about the nature of their business. The danger that RBS posed in 2008 was that if it went down, it would drag down the whole UK payment system as well. The nightmare scenario for the UK government was that cash points wouldn't have worked, wages wouldn't have been processed on the Monday. So I posed some questions at the beginning, and hopefully we got closer to some answers. Is the banking industry a competitive one, where there is a natural order of recycling? Difficult to see that happening, as the incumbents are so large that challengers can only really nibble around the edges. How do we deal with this oligopoly? Via challengers? Is small beautiful? Not necessarily. It can concentrate your investment risk, although they are more profitable. Does the industry find new ways to be profitable, useful, and additive? Certainly it tries. The technological drive in the sector is something we have all benefited enormously from. Part of that has been driven by even the relatively small amount of competition that there is in the sector. Is it profitable and useful? Only in parts and not all the time. Is it a normal functioning sector? Again, only in parts. Should it be a normal functioning sector? That is a wider question I'm sure we can debate. So, to go back to the beginning, are small banks safer than big banks? Not necessarily. They are more profitable, but potentially riskier. They have different advantages and disadvantages, but if we are trying to legislate for the meteorite of another banking crisis, then interconnection may mean that being a mouse or a dinosaur may well not make a difference. And should bank capital levels reflect the dangers of a systemic failure or the risk exposure of individual banks? The problem with this question is that it doesn't actually address the fundamental issue. Banks need to be investable and be able to give shareholders decent returns. Otherwise, when the crisis hits, the equity lever won't work. Bank capital levels should be a cost that is balanced against investability, i.e. the return. Current price-to-book levels seem to indicate that, at least in investors' eyes, those returns right now are not big enough to justify the cost or the risk of investing. And as we wait for the next crisis, that is troubling.